Welcome back to The Explainer. Today, we're strapping on our forensic accounting gloves and tearing straight into the financial statements of TechnipFMC, ticker symbol FTI. We're totally ignoring the headline hype, we're bypassing those slick media soundbites, and we're digging right into the 10K to figure out what's actually happening under the hood of this massive offshore giant. Let's get into it.
But before we dissect the numbers, please keep this mandatory disclaimer in mind. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's look at the facts.
Here's our roadmap for this financial autopsy. We're going to hit the baseline metrics, run the ultimate valuation gauntlet, expose the 7 red and green media blackout flags, do a legendary investor reality check, and finally deliver our verdict on their moat. Section 1. Baseline metrics. Setting the stage. We really have to anchor ourselves with the baseline data before we run the gauntlet. So, TechnipFMC is a $30.83 billion offshore juggernaut. Right now, it's trading at a 23.02 price-to-earnings ratio based on the trailing 12 months, and it offers a pretty tiny 0.25% dividend yield. Now, you might be looking at that and thinking, well, that dividend looks incredibly small for an energy services company, but as we're about to see, that is entirely by design. Just look at this. That tiny dividend hides their true capital priority. Look at Q2. They aggressively shrank the share count with over $420 million in stock buybacks, all while keeping the cash dividend nominal at just under $20 million. They're basically saying, hey, we're returning capital to you, just in a highly tax-efficient, share-consolidating kind of way. Section 2. The ultimate valuation gauntlet. Stress testing the cash. This is where we apply several classic modeling groups to really put this valuation to the test.
Okay, let's separate the surface-level metrics from the hard data buried deep in the 10K. Now, for our cash flow and dividend models, as an intellectually honest analyst, I flat-out refuse to hallucinate discount rates. Because the explicit weighted average cost of capital, or WACC inputs, and the terminal growth numbers just aren't in this specific dataset, a standard DCF basically becomes guesswork. However, their guided $1.3 to $1.45 billion in free cash flow for the year, that gives us a highly reliable absolute cash generation baseline.
Moving on to our hard multiples and balance sheet data. An enterprise value to sales of 3.05x against nearly $10 billion in sales, coupled with that 23.02 PE we talked about, strongly suggests the market is fully pricing in their offshore dominance. They also hold a solid $3.36 billion in equity book value. Make no mistake, guys, the market is demanding a premium here.
Section 3. The 7+7 media blackout frags. Buried in the footnotes. Let's move to the forensic phase and uncover the deep flags those snappy media soundbites conveniently ignore.
There's some real cracks in the foundation, if you know where to look. Let's hit the 7 red flags. First up, Surface Technologies' revenue actually contracted 13.3%. The media ignores this because the consolidated 9% growth masks that regional failure. Second, inbound orders fell 3.7%. Reporters see a 1.0x book-to-bill ratio and get a false sense of comfort. Third, that highly touted Subsea backlog, it's flatlining at $15.83 billion. The media skips over this because the total $16.44 billion backlog sounds massive enough on its own. Fourth, they have a really heavy reliance on the conflict-heavy Middle East, but Guyana and Brazil offshore headlines are just sexier to report. Fifth, future growth relies entirely on margin expansion, not volume. A 23.2% EBITDA margin is an awesome soundbite, so stagnant volume gets totally swept under the rug. Sixth, there's a $19.3 million foreign exchange loss buried in Q2 that adjusted EBITDA conveniently strips out. And finally, elevated execution risk for the second half of the year. Management reiterating their guidance creates a bit of a false sense of security here.
But hey, we have to balance that skepticism with the 7 green flags hidden in the footnotes. Number 1. Q2 free cash flow hit an incredible $488 million. The media ignores this because simple EPS beats get more clicks than raw cash. 2. Gross debt was absolutely decimated to just $420 million. Deleveraging is just considered boring compared to flashy M&A. 3. 90% of that free cash flow was returned directly to shareholders. Buybacks are quiet, unlike those massive special dividends. 4.
S&P upgraded their debt to BBB, specifically noting they could survive a stressed $50 oil environment. Equity markets rarely read credit rating actions, though. 5. Their proprietary Subsea 2.0 tech is what's driving those massive 23.2% margins. It's highly technical engineering jargon, so the press just glosses over it. 6. Capital expenditure is remarkably low at just 2.2% of revenue. The media completely misunderstands the asset-light nature of modern offshore operations. And 7. They achieved a clean net cash positive position of $544.4 million in Q1, which is so often overshadowed by enterprise value metrics.
So we're really looking at the ultimate duality of TechnipFMC here. On one hand, you have this unstoppable offshore subsea cash printer generating massive 23.2% margins. It's beautiful, but on the other hand, you have a wounded onshore anchor in surface technologies that is shrinking by 13.3%. It's literally a tale of two very different businesses operating under one roof.
Section 4. Legendary Investors Reality Check. Graham, Lynch, and Buffett. How would the absolute investing greats judge this stock at today's price? Let's find out.
Let's run the Legends frameworks. Ben Graham, the ultimate value investor, he would give this a hard fail. The PE of 23 is way above his strict under 15 criteria, and the price trades vastly above its net current asset value. The Graham number simply doesn't support the premium here. Peter Lynch, however, would likely give it a solid pass. With EPS up over 40% year over year, matched against a 23 PE, that PEG ratio looks highly attractive for a growth at a reasonable price investor. And Warren Buffett? That's another pass. He'd look straight at the massive owner's earnings, the near zero net debt to EBITDA ratio, and the incredibly wide economic moat created by their proprietary integrated engineering model, and he'd love it.
Section 5. Moat and final verdict.
Synthesizing the data. Okay, let's pull all of this quantitative data together into our final synthesis.
Morningstar defines 5 distinct sources of an economic mode. For TechnipFMC, they clearly dominate through intangibles, specifically their patented Subsea 2.0 technology and extreme switching costs. Think about it. When a massive energy company uses their end-to-end integrated engineering, procurement, construction, and installation platform, their IEPCI, changing vendors mid-life cycle would be financially disastrous. That is a seriously wide moat. So, what's our valuation verdict? Based on the available data, the stock is fairly valued. Yes, the 23x PE ratio absolutely implies a premium, but that premium price tag is completely backed by cold, hard cash flow reality. The 90% free cash flow distribution rate and a practically bulletproof, heavily de-risked balance sheet completely justify the current multiple.
Furthermore, their moat trajectory is expanding over the next 3 years. Their shift to a configure-to-order model standardizes parts that used to be completely bespoke. This drastically lowers lead times for clients and structurally raises TechnipFMC's margin ceiling well past that 23% mark. They are literally leaving competitors in the deepwater dust by industrializing the subsea floor.
All right, here is the final takeaway. The quantitative models are pointing to a highly efficient cash machine, but those hidden red flags we dug up suggest a brewing storm onshore. The offshore cycle is printing cash, no doubt about it, but surface technology is a glaring Achilles heel that is actively contracting right now. So the question you have to ask yourself is, are you willing to overlook the onshore weakness to ride the wave of offshore dominance? Which side are you on? Dive into the filings, run the numbers, and do your own homework.